All right. Good morning, everybody. It's Monday. So the UK is up 0.5%, and Hong Kong is down almost 1%. A lot of talk going on out there about the Hong Kong stimulus or shadow stimulus, and how that can affect a lot of those China ADR plays. A little bit of an unwind when it comes to rates, both here in US and in Europe. We're getting into the later part of the year, so we're going to start dealing with short holidays, short weeks due to holidays. I believe the last week was the last week of full weeks. So from here on out should be shortened weeks. That messes with volatility. It messes with all kinds of things. If you're unfamiliar with seasonality, it's certainly worth looking into. And trust me, I'm not suggesting that we go out and buy things or trade things just because of seasonality. That's not what I'm advocating. But there is a precedent to how a year wraps up, right? There's a lot of background to having a bullish year, having a bullish recovery, or a bullish year after a bad year. There's all kinds of stats, on how far a market can go after we've had a confirmed bear market like we had in 2022. Today we got Home Builders Confidence Index. If you take a look at markets that have been doing good, what you'll notice is home builders is really high on that list. Basic materials ranks pretty good, right? Start getting into 7% with 1 month out, and you get into 1 week performance, and it's second from the top with real estate number 1. And that's what we're talking about this morning is Home Builders Confidence Index. So building materials, houses, everything focused on that is going to be kind of our target today. So we got the 10-year below 4%. We have the US dollar index, or the DXY, below 105 or even 103. That should put us in a risk on marketplace. Should is the key word. Because when we go back and look, this isn't looking so bullish. Yeah. And small caps is doing the best at 0.25%. We got a lot of data coming out of Bank of England and European Central Bank. I got speakers over there just chipping teeth. And the Fed looks to be pricing in 3 rate cuts next year, while the market has priced in 5 rate cuts for next year. Whew. A little bit of a discrepancy, but when we made it through FOMC and seen the new dot plot, the market was validated for that rally that it had picked up, right? By pulling forward rate cuts before the Fed had even suggested that they were willing to cut yet. There's your spot gamma levels. If I go through those too fast and you're not able to get them, just hit me up later and I'll send you a cut and copy. $10 a.m., 11:30, and that is a wrap, other than those European central bank makers. So a pretty quiet start to the week, all things considered. We're still looking for that shift, right, between bad news being good to bad news being bad and good news being good. So something to keep an eye on as you're perusing the news. Just kind of keep a focus on that. I've added something to the morning briefing that I've been tracking for a while now, and I have not uploaded the database with this new indicator. I built it over the weekend. You've got a version of it on most platforms. It's called the CVI, Cumulative Volume Index. So the big fat yellow line in there is the Cumulative Volume Index. And right now I've got it set to the NYSE. What I did differently with mine is I added the Bollinger Bands and a couple of moving averages, the 10, the 20, the 50. That would be for the NASDAQ, and that would be for MX. The reason I'm pointing this out is we've got divergence here. We rejected on the Bollinger Bands, failed to complete that breakout, and headed to the downside last week, while the markets closed on a solid breakout last week. So a little bit of divergence. This is a breadth indicator, so you can find examples of it all over the place. CVI, and I'll get this uploaded into the database once I clean the code up a little bit. So cumulative volume turned around last week. That's kind of the takeaway on that. So right now we're inside week. We're holding above the daily pivot point, but it's not an MDP because we hit it. We hit Fridays as well. We're quite a distance from the weekly pivot. I mean, we're not massively overextended from that weekly pivot. We've brought it up quite a lot if you consider where it was. It was way down here at 45.90-ish, and now it's sitting all the way up here. So we moved it up with us considerably. We're still above it. That kind of gives us a little bit of a reset, right? If you think about where the mean is, and the weekly pivot, trust me, it's not the mean, but it does give us some guidance on like a weekly average, right? Think about how a floor pivot is calculated. High, low, close divided by 3. And we're using a weekly one. So that's a weekly high, weekly low, weekly close divided by 3. And that gives us an average data point, right? Using that as kind of a guide, how far away are we from the weekly average? Are we above it? Are we below it? Are we extended beyond it considerably? And no, we're really not extended too far above it at all. The reason I bring that up is because when you do look at the weekly chart, I mean, that feels really extended, right? It really feels like we've gotten ahead of ourselves and we're too far over our skis. But this says we're doing all right. We're a little extended. Now, if we want to use a more traditional mean, even though it's not a perfect one, the 10 will get us there, and that's at 45.77. We're quite a distance away from that. We're at 47.77. I'm just doing some creative licensing with the numbers there, but it's close enough. It's 200 points away. So I bring all this up to kind of highlight the fact that you don't want to short this market just because. You don't want to short this market because you think we've gone too far, too fast. Remember the bumper sticker or the sticker that I continue to stress you need to put on your monitor that says, no one cares what you think. I don't care what you think. You shouldn't care what you think. Your money doesn't care what you think. Trade what you have, trade what you see. Don't trade what you think. This is not very far, right? In the grand scheme of things, we're not so overbought that it owes us a sell-off. And this basing pattern here, this topping pattern, it could be a top before we fall out. Yes, it could. But it could also just be consolidation before we continue to the upside. One simple metric that we can do for this is look at last week's range. That's a really big range. I get it. Mark out 50% of that range. We need price to close this week above this 50% mark, 47.22. And if we close above that 50% mark, then it continues to be a bullish market. Now we can dip down below that level. We can fall all the way outside of this candle. But as long as we come back up and close by the end of the week above that 50% mark, it's really hard to say that we're in any way bearish. And right now, we're still holding above the 75% mark. We haven't even crossed down there. We haven't even touched it. So we've got this really great setup for some swing trades. A breakout is a continuation, simple enough. And if you wanted to short it aggressively, just getting below the close from Friday would be the start of an aggressive short. Just a short-term trade, right? We're not talking about swinging yet. As a day trade, if we can get below the close of Friday, then we could target the 75% mark. If we get through that, we can target the halfway mark. Yeah, I know. It's easy to say trade what you have, right? Yeah, it's a lot harder to do it. The point of this is just to remind you guys that, you know, when we make those really big runs and you think it's done, and you're probably right, you want to start your positions small. There's nothing wrong with trying to take the other side of the trade without waiting for confirmation, because it's the least amount of risk that you could take, right? To get in before you have confirmation of the short. But I wouldn't size up in that trade yet. You can use pure price methods, meaning you would want to see that lower high and lower low, and then breaking that lower low with a new lower low. You could use moving averages or a combination of pure price and moving averages. those would be nice confirming signals. But you pay for confirmation, right? So if you wait for all of that confirmation, you'll lose position and your risk gets bigger. So going short before you have all of that makes sense as a small starter position. If we bring it into a smaller time frame, we already do have our lower high, right? That 47.82 here. So let's just set it on the 60-minute. We set our high at 47.91 and then our lower high and now another lower high. So we've got the lower highs, no problem. It's the lower lows that's causing the problem here. After that first deep lower low, or just this low here, we didn't get a lower low. That's a higher low, right? So far, we're still getting higher lows and lower highs, and we're forming this wedge. Pure price method says that we need to break this low for a confirmed trigger to the downside. Well, that is also the vol trigger from spot gamma. So it's going to be a little bit tricky. We're consolidating and getting compressed tighter and tighter and tighter like a reverse megaphone. Now, the good thing is this is building up energy. Even though it's not like our normal range, compressing markets build energy. So when the move does come, it's very likely going to come with force behind it, with a lot of energy, which is great. I mean, I'm all down for that. In a smaller time frame, this will be a TRB setup, trendline breakover. And what it's going to owe us is 47.91, 92 really, just running it right back up to the top. There is that call wall though at 4,800. So if we do get that breakout, that's going to be a significant resistance to deal with. The average daily range is 0.75%, 0.78. And we're closer to the top one than the bottom one. I continue to stress, what are we going to do today? We're going to go to that red line. Well, there's two red lines, so which one? Yeah, we're closer to the top one. That, scientifically, that's not going to get us there. It's going to be one of those two, though. On average, that's what we do. We go to at least one of those two red lines, 47.90 or 47.50. Or both, because that's the fun part. We could actually hit both of them. Now, there has been days where we don't hit that red line. I want to stress that. Somebody asked it last week. On average, we will hit one of those two red lines, but it's not guaranteed that we're going to do that. As volatility decreases, the likelihood of hitting one of those red lines decreases. Volatility is a nerd word for movement. So high volatility is big moves, right? Just translate that into normal English. We've got a really low volume already, right? We're going to see a lot of that in the next few weeks until we get into the new year. Markets can make really big moves on low volume. I know that seems counterintuitive. We assume big moves come with big volume, and that's not wrong. But when volume is light, price can move a lot farther with a lot less effort. 10-day, 30-minute volume profile, it's very likely that today we're going to bring the point of control up to our location. It's not 100%. It could take tomorrow to do that, especially if we leave this range before the profile gets brought up. But if we can maintain above 4760 and stay below 4800, then it's very likely that this point of control will come up to us by say Wednesday at the latest, right? There is a considerable amount of volume differential between these two. So, it's going to take a little bit, but that'll help confirm, is this a topping pattern and we're going to roll out to the downside, or is this a basing pattern and we're going to roll out to the upside? If it's a topping pattern and we're going to fall out, we should start to see increased volumes here on the sell side. Keep an eye on the open interest, right? Can't see if that's been hit yet or not. Nope. Okay, we got a new VPOC. $47.70 if you just want to round it. It's close enough. That's untouched. It did not get hit in the Globex, so we're good to go. Below us, we've got 4,700, 4680, and 4660. So we're building up, a considerable lump of those to the downside. We had a reasonably decent move through the kill zone this morning, pointing out just some opportunities. There's the 2 to 4 move, right? The kill zone is between 2 a.m. and 4 a.m. Oftentimes you'll see this big move, and then if you consider that a liquidity gap, it comes back up and closes the gap. Oftentimes the move happens between 2 and 4, and then the gap close happens after 4. But we'll take what we can get. I say it, but I was asleep. I didn't trade it. Just pointing it out. Markets are changing, right? I'm trying to stress this fact that the big violent moves that you're used to trading, if you weren't trading before COVID, then you've never seen that kind of market where, the S&P has a range of 50 points on the ES. In a 24-hour trading cycle, we might move 50 points in 24 hours. A day where, we come in at 9:30, and between 9:30 and 4, we maybe get 12 points on the day or 15 points on the day. Those days are coming. We've been slowly working our way back to that. If you want to kind of get an idea of what that looks like, you can always go back before COVID. So these lines are our weekly expected move. And I just randomly zoomed into a week, right? This is 1 week back in the day before COVID. And I'm just going to keep that box, drag it to where we are now. You see how the current week that we have right now is really close to that random week that I grabbed pre-COVID? So we'll just grab this same box and move it, oh, I don't know, last year before the October low. Here's that same box. What it's supposed to be for the whole week is that big. That was the range that we had last year on a week-to-week basis. You see how much bigger the volatility was back then. What are the distance that we could run on a week-to-week basis was so much wider because we had a lot more volatility. And that volatility is decreasing considerably. You see how much the current week range is. We're almost back to those levels. So we're getting there just a little bit at a time. And I believe through the first quarter of next year, we're going to see even more reduction to this average daily range, or this average weekly range. The weekly expected move is going to continue to shrink. Now, you know, it won't get so small that there's nothing left to play. And I bring this up because you have to adapt your trading strategies. If you're, you know, if you never traded in that environment, you're going to need to pick up a new approach. We're holding above the 10-day moving average 1.38%, and we are on the decline after getting up around 2%. So far, so good. This doesn't have to come all the way back to zero for a reset. There's many examples where we started to fade back and then we rallied back up again without getting to zero. Plenty of examples of that, even a little more recently back in October, November. So it doesn't owe us a 10 MA bounce, and we're not overbought. We can see that we've been much higher than this. Even in the short term, we've been higher than this. So it doesn't owe us a sell-off. We didn't move too far, too fast. We're not overbought. That's on the daily. Now, on the weekly, we're pretty extended, right? We can see that we topped out around 5% and that we've drawn back a little bit from that. We've been higher than that before, but not by much, right? And we can count it on one hand, even if you're missing fingers like me. So we're a little extended from the 10-week, but it doesn't have to fall down to the 10-week to close this extension. All it has to do is hold the line, and the 10-week can come up to us, which means we don't want to try to short this just because of how fast we moved. Or if you do want to short it, do it with a small position. Try to find things that have already, you know, given the setup for a short. $48.21 is the top side of the weekly expected move, and $47.18 is the low end of the expected move for the week. And remember, this is a short week, right? I better check before I keep saying that. I'm pretty sure last week was the last full week. And that this week is going to be a short week. Friday will be a short day. The markets will be closed on Monday, January 1st. Of course, they're closed on Christmas as well. Yeah, I'm pretty sure Friday's a half day. Industrials and building materials are going to be in focus this week. They've been doing really good. You can see XLI with this fantastic move, right? From the end of October to where we are now. I mean, just that's beautiful. A little more ragged, but still a good move. XLB. The problem with XLB is it's still underneath all of this resistance. We did get a trend line breakover, but it does still, when we look left, it does still have all that resistance there. But XLI has already made it through all of that. XLI also has the 5,200 cross, same with financials. And it's not guaranteed, but I think we would have to crash for the 50 to not cross here on XLB. And think about what it takes to move a 50-period moving average and look at the curve that we have there. It was a really fast run to make it slope that much. It is worth noting, by the way, that the lower end, the defense, XLP, XLV, which is staples, healthcare, utilities, they all have the 50 under the 200, but they have the curl, and healthcare at least is above both moving averages. And that white line, the Linreg line, is nearly flat. Same with building materials. All right, Bitcoin down 3%. Some of those Bitcoins were ripping over the weekend. I caught a little bit of that. But they're down this morning. Precious metals down this morning, or at least gold miners are. And banks, solar. What is up this morning? What's that? Metals and mining. Of course, the M&A play on X Steel. That thing was up 26% the last I heard. What a move, right? 26%. Nat gas, uranium, energy, energy exploration. Not the fangs. All right, so we got oil trying to turn around, coming up underneath that 20-period moving average. And it's been a move to the downside, since October. And all of these rallies have just been short the rip, right? Not buy the dip. Now we've failed to maintain above the 20 since mid-October. Even when we had that breakthrough here at the end of November, it was a one-day wonder and back down we went, right? So if we're going to get a chance to run energy back up, and I think 90 would be a bit of a stretch, but we could maybe get back into that 75, 78 area. If we're going to see anything like that, we've got to get through this 20-period moving average. Now, like we talked about, getting in before you've got confirmation is cheaper. But you'll lose more often, right? Think of it like lottery tickets. Lottery tickets are really cheap because you lose frequently. If they were expensive and you lost frequently, nobody would play the lottery. So 73.65 or getting above that 20-period moving average, either one, they kind of equate to the same thing. Getting through that 20 and closing above it would get you to that 73.65. If we can do that, then we can focus on this critical level, 75.65, and then start working on these upper levels up around that 50-period. That would be around the 10-week. Gold miners hit this resistance up here and fell back Friday and then fell back again even more this morning. We're at a level where we could bounce that 30.72. It's the top of this really big bar. So getting that gap closed makes perfect sense, coming down and actually getting the 30.70, getting the gap closed. Maybe even overshooting that a little bit and bouncing on the 10. But otherwise, we're getting higher highs and higher lows, and this could continue to go to the upside. I'd keep my eye on precious metals for a long play after it digests that move that it had. To kind of give you something to keep your eye on with that is you're going to want to see US dollar Japan moving to the downside. You want that going down for precious metals to go up. We had bonds and quote stock this morning kind of working together, and then that split apart. Now we've got a solid move to the downside in bonds, but the S&P and the NASDAQ are trying to bring it back up again a little bit. So we want to see that split widen out, a little bit of risk parity. It doesn't have to, but it'll help, right? Keep your eye on the Dixie. I don't think the 10-year is going to be very helpful if we do continue to see that divergence with bonds going down and stocks going up, because with bonds going down, the 10-year should go up. That'll be the 10-year up with stocks up. And that's not really what we are used to, right? We're used to the 10-year down, the dollar down, stocks up. Well, if that's what we're going to need, then we would need to see the bonds find some support and continue to hold these levels that they gained. You see bonds here trying to come up off of those lows, but they've made a considerable size move, right? So they need to digest this a little bit. That's the 50-week. And after such a really big move, it makes sense that they're going to kind of pause here and digest this a little bit. But if they digest and pause, then we're not going to get a lot of help out of the 10-year either way. And that's going to take us back to watching the dollar index. So, I'm not the one to ever say don't watch data, but I don't think the 10-year is going to be very helpful if bonds stay down. Not today. I think it might be easier just to look at what's up first. Nat gas, oil, energy, uranium, silver. I was hoping to find maybe EV markets or pot stocks, something, but no. It's all energy all the way and a little bit of precious metals. IWM is picking up a little bit, so we do have, some of that too. But otherwise, with Bitcoin down, KWEB down, that's a huge chunk of the market, and we're not getting any help out of the FANGs yet. So we don't have anything yet. We got to get, and solar's down. So not all energy is up. Commodities are down with DBA. And we're getting some kind of a mixed signal here, because gold miners are down. But silver's up. And gold is trying to come up. This is a very divergent, choppy market. Take a look at X Steel. Couldn't resist, had to bring it up. That's a fantastic move. How come they're not showing up here? I don't like it when my tools aren't working. Let's see where we missed that. All right, XPEV's about flat. Oh yeah, NEO's up. Closed at 8 and hit $9 this morning before pulling back. Let's just take it all. Nice heads up, by the way. I'm gonna have to figure out what's wrong with my EV marker and why it didn't trigger this morning. But we got NEO, if it can keep it. Needs to hold above that 8.5 level, which is still much higher than where it broke out, right? Because we closed at 8. With that in mind, one thing that you can do is mark last week's high. That'd be 814. On the week, you don't want it to get back inside that range. And then beyond that, you've got this IX10 at 825, or take it a little bit bigger. Let's see if we can. If we can take it a little bigger, this will be perfect. 851. So we were IX10 inside of this week right here. That is the candle of control. Now you can wick down into that, but you don't want to close inside of that, right? So keep it above 8.5. And that lines up really well with what we were already looking at on the lower time frame. That's also the 20-week moving average. So, you know, in the grand scheme of things, this could start to develop into a really big scoop pattern. Just be aware that we had the same thing earlier in the year, right? We started a really nice scoop pattern and then it just fell out of bed. But we're just getting started, right? This is just kind of getting the engine warmed up a little bit. All right, Li Auto is not one of those that are moving to the upside this morning. But F-Cell, big push. Looks a lot like NEO. We're through the 10 and the 20 week. That leaves us focused on the 50 week. A lot of work to do if we're going to turn this thing around. This is some of that bottom fishing stuff, right? Short covering rally is exactly what we're looking at here. All right, we closed at 316 and we made it up to 345 this morning. Almost an inside day breakout. Well, actually not even almost. We did. We managed to wick outside of it. And then we failed and came back in. That's a beautiful TRB setup. If we can get that follow through above 345, we could get into 4, maybe even 4.25. Long ways to go before we consider this a roundabout, but for a day trade, you know, certainly. So thank you for that, by the way. I'm going to check my system later and find out why my EV names didn't come up. But for the recap, it's NEO, Blink, and F-Cell. Now, if all I was doing was just looking at names that were up this morning, that's a simple thing to do, right? Just to find individual names. So, you know, X obviously is up or was up 26%. You know, and we can go and find names that are up in the pre-market. It's finding groups, sectors, industries, subsectors. So Neo, X Steel, those are high on the list. F-Cell, right? Those are really high volume names in relation to their average. We can see the average 10-day volume here in this column, and then the volume today right next to it as comparison. And you can see Neo, for an example, it's not above that number yet, but it's already up significantly this early in the morning. And, you know, it's got a pretty good size gap this morning too, 8.4%. X Steel over 28% now. Woo-hoo. Hmm. We'll see how far that news carries them, but so far the market really seems to like it. That volume is lit up. So what I would want to see today, if I'm going to look for a continuation, would be at least the fangs, right? We're going to need one of those two risk on sectors. So at least the fangs themselves with maybe some financials. I don't think the financials can do it on their own unless the fangs are at least flat, right? They can't be negative at all. So Apple would need to turn around and kind of get cleaned up a little bit. Look at all those dark pool prints. Looks like Tesla wants to break out. And the rest of them are just sideways. They're not selling off necessarily. Apple looked the worst of them, but Apple had news too, right? There was another ban of Apple phones. I think it was another China. I didn't catch the name. It was right before I started streaming. I just knew it was negative Apple news. But China had already been banning Apple phones, so it makes sense that it was probably more of China. But I don't know for sure. But that would explain why they're down this morning. The rest of them are just sideways. So hard to see a rally in the S&P if we don't have, you know, one of the two sectors that we need. Three if you count consumer discretionary. Barron's, I guess, gave Snap an upgrade. It wasn't just Barron's, though. It's a number of firms, and this is one of them. I think 23 is a bit high. So look, we've talked about this before when it comes to analyst rate changes. The headline is always, the sexy, glamorous, shiny object, but you want to find the upgrade article and find out where the upgrade comes from, especially when it's a big change. A lot of the headlines are like no change upgrades. I hate those, right? Because they just put out a statement saying we're going from neutral to neutral, and they just adjust the price a little bit, and it's just a waste of your time. This one's not a small change. This is the big change. And those rate changes generally come because something new fundamentally is being priced into a company. So with a situation like this, going from $9 to $23, you have to ask, where'd they get that number from? Right. And so that's where reading the article rather than just the headline can get you a little bit farther and have a better understanding of where price should stop at, or why we would believe it's going to continue to move in that direction. Morgan Stanley boosts target on Netflix, and it's up a little bit this morning. All right, everybody, watch the clock. There's not a whole lot of it today. Look for that rising tide. I think that's going to be the most helpful. And remember that we need to break this low to even get started with an idea of a short for any sort of confirming signal, right? But shorting from the highs is your lowest risk entry. And looking at it on the daily, all we've got here is a tightening pattern, right? This is a wedge. It's just tightening more and more. That's a bull pennant. This could be consolidation before a breakout and a continuation up. It does not have to be a short signal, which hopefully I pounded the table enough on this morning that you don't just run out there and try to short this sucker. If we can break out of the IX10, which it's not a fantastic IX10 to begin with, but the consolidation helps. If we can break out of that, we got to get through this high, 48.08, but then we got 48.36. And it looked like the Russell was going to be the leader on this. That's going to throw a lot of our tools off. like the tick, the AD, cumulative tick, things like that, they're not going to function the same way if Russell is the leader, and it's not going to show up, like our Dow names and blue chip, mega market cap, Magnificent Seven. Those names are not the ones lit up this morning. So they're a tell of their own, worth watching. You can just watch NY Fang. Right there. I know using the weighted Mag 7, we don't have this big of a breakout, but using NY Fang, that breakout right there has been waited on by a lot of analysts waiting for this as the start of some next leg rally. We're talking, 5,000 in the S&P. So we broke out. We got to keep it. Put it on the weekly so it makes sense. This breakout that we had last week, if we lose this, I think we sell off into next year, right? This has to hold. So we can dip down below 8,400, but we need to close on the week above that line. It has to keep. And as long as we're above this, trying to short the broad market, I think is just going to be wasting money. Everybody, be careful, be safe. I'll see y'all tomorrow.